All right. Well, good afternoon, everybody. Welcome to this month's section about just the markets, general economic comments. It's been pretty eventful over the last, I guess, 30 days since we last did our previous one. So I'll jump right into it. Like I said, today I'm going to aim to probably chat for about 20 to 30 minutes, a little bit shorter today. Obviously, things have been pretty fluid with what's going on in the markets. It was really tough to actually put something together for this session, just given the fact that, I put it together even as recent as 24 hours ago. Things can change so quickly given everything that's going on in the world today. So again, I'm just going to focus on just what's happened over the last month, give you a little bit of an outlook of things that we're paying attention to, and then also just more of a fundamental outlook on some of the things that's happening in the economy. Just a couple of housekeeping notes before I jump into it. If you do have questions, and I encourage you to ask, given that it's a shorter session today, please actually write them into the Q&A section. I have them up on my screen to the right. I will try and have a look at them as we go through. I'll do my best to get through all the questions today. If for whatever reason I don't get to yours, I will try and reply to you via email. So without further ado, we'll just jump right into it. As you know, I always start with these, and yeah, what is the new normal, I guess, is the great question. Over the last 6 weeks, I think the new normal, like I said, has become pretty predictable, I guess. What happens today can be obviously much different tomorrow. And it's been a difficult challenge to navigate the uncertainty. But I think given our approach of being disciplined, looking at the mid to long term, and as you've heard me talk before, I always think of long term, not 20, 30 years out, but I think about it in market cycles. So a market cycle is anywhere between 5 to 7, maybe 8 years where, we get, a bull market, which is defined by an increase off the bottom by 20% or greater. And then we get this bear market contraction, which is a decline of 20%. And generally those cycles are between 5 to 8 years, depending. So I think right now, when we look at where we are today in the cycle, we're probably 2 years into this bull market. That started in 2023, I guess almost 3 years now. We have had a couple of corrections along the way, which is defined as a 10% decline. We saw that last year with Liberation Day, with trade and tariff-related news. And believe it or not, we're pretty close to it again. NASDAQ stepped into correction territory in March. Since has reversed that trend. But yeah, like I said, we've seen a lot of volatility here in the last 2 to 3 years, despite us being in a full-fledged bull market. So let's just jump right into it. March was a tough month, guys. From the period of March 1st to March 29th, markets fell anywhere between 7 to 8% here in North America. So what we're looking at here is, the 4 major indexes here, or indices here in North America. So NASDAQ, S&P 500, Dow, and even the TSX. So the TSX performed the best out of the 4. It's actually been quite resilient. I'm going to show you a slide in a little bit. It's been the best performing market of the year. Despite everything that's going on, it's still in positive territory, which is fantastic. I had a great year in 2025. So for our approach of diversifying the portfolio, of having multiple geographic sectors or regions plus the various sectors, has actually worked out really well in terms of smoothing out the declines that we see in the market. So we've smoothed out the drawdowns, but we've still been participating on the upside, which is what we want. So fast forward, obviously we had a temporary ceasefire that was announced here just recently over the last few days. And this is just a really general outline of what they kind of put together. I'll talk about it tomorrow in my commentary, but if you had to actually describe the ceasefire, I'd probably say it's fragile at best. I think it's actually good progress with the optimism of actually having a potential resolution here in sight. But the reality is it's a very fluid situation. A lot of different things here, a lot of challenges. We've already seen in the last 24 hours, Iran came out and they said, hey, already there's been 3 points of this 10-point ceasefire that has already been broken. Good news for us as investors, markets we're pretty positive today. Started the day flat, but we had some positive news early this morning, and markets picked up thereafter. So largely driven by news right now, the direction of the markets. So again, quick turn of events. So this is just what happened when the ceasefire was announced. So we look at both the Treasury yield and the price of oil. Obviously, after peaking here earlier this week, late last week, oil fell dramatically. Came down almost 15%. And this is what I would anticipate happening as a resolution becomes more firm. I think we're going to see a pretty quick reversal of the oil price. Although the impact of what's happened already here over the last 6 weeks, I think will take a little bit of time to kind of work through the system. And then more importantly, the Treasury yield has also fallen as well, which is ideal. For a lot of you here, you might say, oh, well, how does that affect us? Well, if you're actually looking at doing a mortgage renewal or what have you, these yields actually affect mortgage rates. So we actually have seen mortgage rates, I wouldn't say spike, but they've increased over the last 6 weeks. And we've seen a little bit of a reprieve here with this temporary ceasefire or maybe call it a preliminary ceasefire that we've actually had here in the last week. So I think one of the things that's really important as investors, and again, if you haven't heard this term, there's this term that came out last year called the taco trade. And a little bit of tongue in cheek, but it stands for Trump always chickens out, okay? And what that means, and we're getting used to it, it's kind of like the old story about, the sky is falling, right? And he comes out and he has this very strong opinion. He has actions with a very specific deadline, and it causes markets to move in a negative fashion. And what happens is we get closer to that deadline, lo and behold, he either delays, what he said he was going to do, or he pushes it out, or what have you. Markets have a significant upward trend. So here's a chart of just last year during trade related news out of the US and the tariff announcements. And what's really interesting, this goes back to obviously when the US elections happened. There was obviously that period of euphoria between US elections and then the new year, we saw a significant upward trend. But then as he took office, obviously the tariffs were announced in here. And then we saw this significant decline. And that continued. Again, this is where I was saying the NASDAQ actually dipped into a bear market territory for a very brief time, but we had a significant decline until he came out and he paused tariffs here. And then we saw a significant rally on the other side. And actually, if you look at this one day, this was a 1 day upward trend. Most North American markets posted their best single day return in history. The NASDAQ, which is largely made up of growth companies, things like Amazon and Microsoft and NVIDIA and so on, that market 1 day was up almost 13%, which was phenomenal. So we look back at what's happened last year. We fast forward to here we are now through a second fairly significant situation within his presidency, and we're seeing much of the same. We're seeing the same thing where he's coming out and saying, hey, we're going to quote unquote annihilate a civilization. I'm going to give you till 8 p.m. and 24 hours or 48 hours. And lo and behold, things like this get resolved, or we get a temporary or preliminary ceasefire. Now we see markets turn the opposite way. So again, this is just becoming kind of part of the playbook. And I think what we're seeing is, it's starting to fall a little bit on deaf ears. We're not seeing as much movement in the markets when there's some of these significant announcements. I guess what the challenge is here for us investors is simply, what if he decides to follow through with some of his actions? That is the biggest issue. So that's why it's really important for us to continue to be on more of the conservative side, be cautiously optimistic, but recognize that if we do get some volatility, the portfolios are positioned in a way to help navigate that, as opposed to us making significant changes on that 1 day. You try and plan for it. And if we go back to last year, and I apologize, I'm staying a little bit of time here, but I think it's really important. Back when the trade and the tariff news were coming out, we didn't make decisions on these sharp, declines or these gains, but rather we made decisions during these periods of time to protect our clients during this. Okay. So for folks that were emotionally driven to make changes because of the uncertainty, if people would have gotten out of the markets, and gone to cash in these periods of time, this significant uptick in the market, they would have been sitting on the sidelines and they would never capture that gain back in their portfolio again. So timing the market is just really, really difficult. Okay. Now with optimism comes rebound. Okay. So if you look at the March 31st onwards, so the last, I guess, what is that, 8 days now, 9 days, we've actually had a decent run in the market. So, the best performing market has been the NASDAQ, which is up 6%. Weakest has been Dow Jones, and the other ones have slotted in between. So we've seen in a lot of cases portfolios move 1 to 2 to 3% just in the last couple of days alone. So I would anticipate, the trend to continue to be upwards if this resolution can be maintained. Okay. And then when you take a step back and then look at it overall, from the start of the year till April 8, here's what the markets have done. So despite a lot of the volatility, markets are down, NASDAQ again down 5, the other one was down nominally 2 to 3%. And then here we are, TSX, strongest of the bunch, up 5.5%. Really pleased with that, but this is the reason why diversification matters. We're not overweight in the US. We've done that strategically, and we have added Canadian holdings over the last 12 to 18 months. And so this benefits us. We have pieces of the portfolio that are trending in the right direction. And even the other portions that are maybe a little bit more sluggish, we benefited in previous years. And collectively, like I said, what that does is it just smooths out the overall returns. And over the long run, investors, they have this good experience overall. So let's shift into the economy. That's the markets. Let's talk a little bit about the economic outlook. And I think one of the biggest things that we're seeing right now is inflation-related news. Okay, this is a great one I came across that, probably the worst kept secret. Inflation likely will be on the rise. And so when we look at that, why is that? Well, the biggest one is obviously the oil shock. The thing with the price of oil is it trickles down into pretty much everything. So anybody that has a gas-powered car, you go to the pump, and we're paying over $2, $2.10, $2.20, depending on any given day of the week, per liter to fill our car. In the States, it's over $4, pretty significant. And that's just not affecting us at the pump. That's everything that we're going to actually be consuming in the foreseeable future here is getting more expensive. So the cost of food, the cost of goods that we're buying, because there's trucks and there's transport companies that are moving those goods around the country. If it goes up for them, it's got to go up for us. It's not going to get absorbed by companies. We're seeing this if you have travel plans or surcharges that are being, for some airlines, they're charging additional fees at the airport because the cost of fuel has gone up. So again, everything is going to trickle down. And when you look at this chart, it just graphs the inflation data versus the cost of oil. And again, it will likely trend upwards. We're going to likely see higher inflation numbers in the near term here. And again, this just talks a little bit about the gas prices. So again, when oil goes up, when gasoline prices go up, you can actually see there's a relation with inflation. So oil, obviously the gas, and then gas is more expensive. It makes up a big portion of that CPI data. Therefore, inflation will likely be on the rise. And the longer the Strait of Hormuz is blocked, or a few ships are passing through it, then the cost of oil is going to stay elevated. And what we're going to see, hopefully, with the ceasefire, and we've already heard it a little bit today, although it's not fully open, our ships are starting to pass. Therefore, hopefully, this glut of goods and oil and so on will start to move freely. It's just not oil, obviously fertilizer. The big portion of fertilizer flows through that strait. So even just the cost as we're going into the season where a lot of farmers are planting and they need fertilizer, things are just going to be more expensive for them as well. So it's all that trickle down effect, I think, which is really critical that we need to keep an eye on. And how does this impact us? Again, from a central bank point of view, U.S. Fed is likely going to keep rate cuts on hold. We actually anticipated this year we'd probably see maybe 1 to 2, maybe 3 rate cuts out of the U.S. Fed. I talk about this often. Obviously, the cost of debt, cost of borrowing, if it goes down, it's better for consumers, companies, everybody involved that actually has any debt out there. What we actually think is we're only going to see maybe 1 cut this year if we're lucky. I just saw some data today where the U.S. Fed still believes they're going to cut at least once. I just don't know how quick that will be. What's interesting on these 2 graphs, Canada's on the bottom, US is on the top. If anything, here in the later stages, they're actually forecasting increases to the central bank rates, but not here in the near term. We think they're just going to flatten a little bit before we start seeing them decline. Good news here in Canada. Canada is actually in the late stage of rate cutting. So we actually didn't expect too many rate cuts from them. So doesn't really impact us too severely in terms of the borrowing costs. But in the US, again, they're quite a bit substantially higher than where we are in Canada. So any slowdown in their rate cuts obviously will affect their economy and just the cost of borrowing in general. So this I thought was an interesting chart. So again, I'm talking about oil quite a bit right now, but we look at North America, both Canada and the US. The way to read this is when we look at LNG, liquid gas, and then on the left side we have the oil. When we look at Canada and US, we're not significantly impacted, or we shouldn't be overly impacted from what's going on in the street, because we have less dependency based on what is flowing from that region. That being said, we're obviously impacted by the cost of rising oil in general. And so when it goes back to when we talk about diversification, the good thing about diversification is that Canadian companies are benefiting from a higher pricing of oil. So if we own some of those companies, obviously that offsets some of the weakness that we're seeing south of the border. Okay. And then when we look further out, guys, this I think is really important. We're caught up with it today about what the price of oil is. And again, this changes daily. This was a fairly recent chart, but again, over the last 2 weeks, oil has just fluctuated so much. What this chart is actually looking at the futures data, which means where do we think the price of oil will be in the future? And so when you look at today, it's much higher. The futures have significantly increased here in the short term. But when we get further out, we get out 5, 8 years or what have you, the price of oil, they anticipate this impact even as much as a year from now, guys. The effect of the impact of high oil on the future market of the pricing should be actually negligible. So we're going through this period of time right now where we're seeing this rapid shift of pricing with this, obviously commodity that everybody in the world most often needs. But to the mid to long term, I talk about those cycles, things should actually revert back to the mean, which is good. And then again, we're really focused on the negative news, I think, in the markets right now. The reality is, there is some positives that are out there. And I continue to talk about, is this economy and market, is it event driven? Is it fundamentally driven? Again, I think there's 2 things going on in the markets. I mentioned this in the last session. We both have an event driven market, which we're seeing, based on news and data that's coming out in the Middle East, whether it's optimism or pessimism, which is moving the market. But underpinning that the markets is the fundamentals. How are the earnings growth? How are those going? How is GDP growth going? How is labor markets going? And in general, it's more optimistic than negative. And this is just a chart that talks about the GDP growth, in Canada. So when we look at, the last quarter of last year, yes, we saw a contraction. Okay. Previous to that, most of the actual periods were positive. And the forecast coming into Q1, which we don't have the data yet, but they believe there is going to be a reversal from Q4, and we're actually going to see it turn positive here in the first quarter of the year, which is good. Just a quick comment, I had a chart in here, I took it out. One of the things I've started seeing in the news a little bit is the talk of a recession. Okay, and I thought I should probably comment about it a little bit. So could there be a reality where we enter into recession? It's possible. Looking at this chart, and the definition of a recession is back-to-back quarters of negative GDP growth. Okay, So what generally happens on a recession is it's backwards looking data. This is really important. So we could actually go another quarter or 2 quarters before, the Bank of Canada comes out and says, hey, we're officially in a recession. So we could have 6 to 7 months go by before we actually recognize and announce that we're in a recession. Well, the same is true when we come out of a recession. Markets generally lead us out. So what that means is we could be in a technical recession based on the data, but markets will recognize that, hey, things are picking up. The market starts to pick up. And then generally speaking, same as when we get it announced into it, it's backwards looking. And so what happens is we could be 3 to 6 months before they come out and say, hey, actually, we exited a recession 3 to 6 months ago. So it's, again, important as we actually work through these periods of ups and downs and recessions and so on. This is nothing new. We've been talking about kind of this recessionary period since before 2022, which was our last bear market. We did not go through a recession. We skirted it. I don't think a recession is on the horizon quite yet, but it wouldn't surprise me if we do hit one at some point. But I don't think that's a near-term concern at this stage. Okay. And then my last couple of slides, again, I talked about this before, and I've talked about this quite often in my sessions about the profit margins, the earnings of these companies, and so on. So when we actually look at what's happening both in the S&P and the TSX, both U.S. and Canadian markets, and also NASDAQ, we can actually see, as we came into the year, profit margins, earnings, and so on were actually improving. And we're getting earnings right now that are coming out, and they're strong. They're beating expectations. They're above analyst forecasts. So again, from a corporate point of view, things are still moving in the right direction. Yes, we're getting a little bit of a drag when it comes to some of the labor markets, some of the layoffs, and so on. But it's still fairly healthy. Last data that came out, they actually added jobs versus had a contraction. So again, things are pointed in the right direction, although we're a little bit more cautiously optimistic than what we were before, just because we don't know the true effect of what this Middle Eastern conflict is going to have on the broader markets and economic growth that we're seeing right now. Okay. And so my last 2 slides, I said I had 2 slides, the last couple of slides, very market specific. So I think this is important too. So the market breadth is actually improving. And what I mean by that is when we go back to 2023, 2024, 2025, a lot of the gains came from the Mag 7s, a Magnificent 7, or maybe even Magnificent 8, the top portions of the portfolio, the markets, which was generally, again, the big tech companies, the NVIDIAs, the Microsofts, the Google, Amazons, Teslas, Broadcom, so on and so forth. A large portion of the gains that we saw in the markets, S&P 500, NASDAQ, and so on, were driven by those handful of companies. Okay, so the majority of the annualized rate of growth on the markets, they did not come from the 500 companies on the S&P 500, but roughly the top 8 to 10. But what we're seeing now is we're seeing a little bit of a break from those kind of strong performance from those top companies. And now when we look, we're seeing much more broad growth in the market. So 56% of the companies that have been reported on the S&P 500 have actually been outperforming the index. So we haven't seen it this large since 2022. And even before that, we'd have to go back to roughly 2013, 2010 to see this kind of breadth of growth within the S&P 500. So again, yet again, a positive sign in the markets in general. Okay. And this is my last slide. Again, I've talked about it before, but I don't know what's going to happen in the next 3 to 4 weeks between now and our next session. Okay, we could go through another period of volatility. I know they have a 2-week kind of pause with this tentative or preliminary ceasefire that they're trying to get nailed down. Somebody asked me, they said, well, are we going to get to 2 weeks? Like, what's going to happen in 2 weeks? Are we going to, is Trump going to come back out and say, hey, you know what, we're going to bomb all bridges and so on again, infrastructure, if we don't get this done? I actually don't think we're going to get to 2 weeks. If I had to guess, I think 2 weeks is a long time in this quickly moving situation. I actually think if they break that ceasefire, it's going to happen probably within the next week if we're lucky. But again, if they do everything right and they all work together hopefully that 2 weeks comes and goes. So again, if we see volatility pick up, again, this is a good reminder. What this chart shows us is it just simply shows us the calendar returns of the S&P 500, which is the blue bars here. And in most cases, you go back over the last 45 years, and it's in positive years. Yeah, I don't know how many. What's this? 1, 2, 3, 4, 5, 6, 7, 8. 8 of the last 45 years have been negative. The other 37 have been positive. Okay, so you do the math on that. 75-80% of what this chart shows has been positive annualized returns. But what's interesting is pretty much every single year of the 45 years, there has been an intra-year drawdown. Okay, much more significant on the decline than where it ended for the year. So I'll give you a really good example. Last year, again, trades and tariffs through Liberation Day in early February, March, April, markets fell almost 20% during the year, but the S&P 500 finished up 16%. Okay. Even when you look at, this was 2019, I guess in here, negative 7% at one point in the year, finished plus 29 in 2019. And this is COVID. This is incredible. And we all lived it. Everybody we've worked together since, pre-2020, this was very short. This is one of the shortest bear markets on record, and one of the quickest reversal of fortunes, between when COVID was announced, the decline, and then the upside when things started to, again, there was a little bit more certainty within just the global outlook. So again, this is a stark reminder that volatility is common in equity markets. And if Canadians and investors want to outperform tax and inflation, okay, and they own equities, we all have to accept a certain level of volatility. Excuse me. And if we're not comfortable with it, then what we have to do is reevaluate the risk, reevaluate maybe the time horizon, and actually reduce the amount of risk that people are taking so that we minimize the declines. Now, just for the record, guys, even though these were the annual market declines, the intra-year market declines, this is not what our clients experience because of the way we position the portfolios, as I mentioned, from a diversified bunch, by owning different geographic regions, sectors, public, privates, all these various things. Your drawdowns were much more less than what the markets were in general. Okay, so again, if we go through it, just recognize it's just part of kind of getting through the year and getting good, strong returns over the long run, and meeting your expectations in terms of what you're trying to accomplish with the portfolio. Okay, so that's my last one. I do have a couple of questions that are coming in, so I will answer them. So just hang tight. Let me see here. Oh, I love this one, guys. This one, and thank you for this comment. It says, "This is great info. Do we have a chart now that shows who's going to win the Masters tournament?" I don't. I do have some predictions, but for those of you that are golf fans, Masters started today. I will not tell you who's at the top of the leaderboard in case you were taping it, but it definitely looks to be a fun and exciting weekend ahead for those of you that follow golf. But I do have my picks, my favorites. Maybe I'll share those in a different commentary. So, okay, I have a couple other questions. And somebody that asked, they said, "Hey, given the uncertainty in the markets, is there a way to hedge beyond what we're doing today?" And so the answer is yes and no. So what some people say, I want to hedge by adding cash to my portfolio. I think this is a really difficult situation to try and time the market, to shift from equities to cash, to try and reduce the amount of exposure we have. So again, not my first option, but we can do it. We've done it for some people. It's just if things move quickly, we're just sitting on the sidelines, and unfortunately, we're not capturing the upside. So the other things we can do is we got to take this approach where we're trying to manage risk. We backtest portfolios to get a sense of how things are going to perform in any given market. And then the other thing that somebody asked was, they said, "Well, what about if we bought commodities? What about if we bought commodities or an ETF that maybe tracked oil, or again, hard assets like gold and silver and fertilizer and so on?" And so that is another option as well. We can do that too. The other option is you can also just short the market. And what shorting means is if the market goes up, if you hold an inverse related investment, market goes up 10%, you're going to lose 10% because it does the opposite. Markets go down 10%, then the investment you hold goes up 10%. So that's what's called like a long short strategy, which again, I'm kind of like jumping ahead, but we actually have been researching some long short strategies that hopefully in the next couple of weeks, we're going to be introducing to the portfolio. We'll likely send an email, but a long short strategy does exactly that. It says, hey, we want to participate in the upside, but if there is some downside risk, are we able to capture, some gains when things go down? So again, I think there's some strategies that are out there that we haven't been necessarily employing at this point. But I think it's something as we're getting through this choppiness in the markets, it's becoming more frequent. I think having a long short strategy might make some sense. So just stay tuned for that. Like I said, I think that would be something that would be a good complement to the portfolio. So number one. Somebody asked here about, again, about, our investors tuning out, Trump and his rhetoric. I mentioned this earlier. I do believe that they are. Again, he's kind of, not to say he's all bark and no bite, but, I think their challenge right now, the administration with an end game here. I don't think they already had it well planned out. It's just my opinion for what it's worth. This was, I believe, I read early that this was the 8th country that the U.S. has had a conflict with since Trump took office. Okay. And most of his other kind of conflicts, in the most recent one before this was Venezuela, it happened very quickly. It was mostly done within I don't even know, 24, 48 hour time frame. My guess is they probably thought something similar was going to happen this time around. We're now almost 6 weeks into this conflict. I think if anything, they're looking for a way to, that it's for both parties to, I don't want to say save faces in the right way, but they both want to win. So it's going to be tough. So I think the ceasefire is definitely a move in the right direction. I think it gives them both the opportunity to check things off on their box, but I really do believe the U.S. has to make some decisions to move forward. They have enough things going on just in their own economy, let alone to be accumulating some significant debt, and they already have a high debt load right now. So that being said, like I said, hopefully this resolution, there's some legs here that we're going to see hold. So, and then the last one, I guess somebody asked here again about mortgage rates. Again, mortgage rates have softened a little bit here in the last few days, given the preliminary ceasefire. We have actually, again, seen them trickle up on the upside. So again, if you're looking at renewing, we have a lot of mortgage renewals, or we've been having some conversations. Feel free to reach out. What we're finding is that 3-year, 4-year, 5-year rates, they're not much difference. I think the majority of our clients are going between a 3 to 4 year, but it depends on everybody. It depends on your situation. Depends if you want to lock in a rate versus, having a floating rate or what have you. But again, if you have a renewal, if you have questions, if you're dealing with the bank rate, but if you have some questions and you want to just bounce it off us, feel free to reach out. We're happy to provide our comments and our opinions. So, okay, well, listen, guys, I'm going to let everybody go. It's a beautiful day today. It's been a great week. I hope you guys have some good plans for the weekend. If you guys have any questions, comments, feel free to reach out. In the meantime, kind of hang on. Things, like I said, I think are going to get a little bit better. I'm hoping, we hope it doesn't deteriorate here. But like I said, if it does, I think we position our portfolios pretty well. So again, have a great day, and we'll talk to everybody soon. Take care. Bye now.